Hello, everybody. Thank you for joining us today this Saturday afternoon. My name is Jesus Nafanal. I'm going to give you a quick overview of what hard money lending is, give you some tips and tricks so you can help maneuver through this industry. Some disclaimer, today's presentation should be interpreted as legal, never interpreted as legal, tax, or accounting advice. This presentation is for informational purposes only. Contact your attorney, CPA, or business advisor for advice about real estate business and related transactions. All right. So my name is Jesus Now, and I work at Express Capital Financing. We are a hard money lender with focus on different forms of financing, bridge loans, construction loans, transactional lending, and long-term financing. I've been with the company for 5 months now. All right. Before I jump into the hard money aspect, I do want to give you a little overview, really kind of how hard money kind of evolved a little bit. Before 2008 financial crisis, hard money was available, but also the 2008 financial crisis created opportunities for hard money lenders and investors to really jump into an industry with immense profit opportunities. So, 2008 financial crisis, as you may know, it really devastated the American housing market, and that also created opportunities for certain individuals who saw the potential. So the individuals who saw the potential were real estate investors who really sought to buy distressed properties to rehab them and resell them. However, there was some setback. There was an unavailability of funds, and this created somewhat some setbacks for these investors. However, something did change, and private individuals did see the opportunity to lend to these individuals because they also saw opportunities for themselves. So lenders woke up to the idea of lending to a market that needed funds to really grow, right? So and help fill the gap. All right. In this section, we'll be discovering what is hard money. What is hard money? That's the $100 million question. Why use hard money? How a hard money loan works. Hard money rates and terms. I know you guys are waiting for this. I put this so many of my clients call me as the first thing they want to know. All right. What hard money lenders consider when funding a property. This is also very important. You have to understand that every hard money lender works somewhat a little bit different, and then they have different criteria as well. It's really good to understand the criteria so you know that your deals can get funded and you're not wasting your time in getting deals that will not be funded. And lastly, we'll be covering the hard money loan application process. What is a hard money loan? What is it? All right, and a hard money loan is an asset-backed loan um, that is usually for a very short period, very short duration. And I do want to emphasize that what makes hard money unique to other sources of financing, specifically traditional financing, is that unlike traditional we hard money, we base it solely on the asset's income potential and its potential for resale, right? So we're not looking at your income or tax information. All right, we're basically solely on the asset itself. And I do also want to say that hard money loans are really associated with fix and flip loans, but that's not the only thing the hard money lenders the only programs that hard money lenders have. They also have transactional lending. They also have bridge loans as well. And these are very short duration loans. It could be from a day to a month to a year, usually a year or two. All right. Why use hard money? Why not use traditional sources of financing? And we'll be covering this in further detail shortly. All right. Hard money is a viable option for not so deep pocket individuals. All right. So when you go to traditional lenders, they require either 20% down payment. But when you look to fix and flip the property, you're looking not only for the purchase price, but you're also looking for where you have money to help you accept value. So that's what you want value in these properties. All right. So it allows you to put minimal down and help you realize our potential. Leverage. Leverage is another big factor of why individuals come to hard money lenders. Right? So they want to increase their returns. They know that good debt when used accordingly, when used appropriately, can maximize returns. And then let's understand the game. We understand what your investment goals, what your strategies are. We've been in the industry for many years. So we know what we're looking, we know what our clients are looking for, and we can better help our clients in that manner. All right. The reasons why to use hard money lenders, and these are very important reasons, which when I speak to my clients, usually one of these is timing. Timing is of the essence. Money is time. Time is money, as I say. Time is money. Especially in this hard market today with properties that are being sold like cupcakes very fast. You want to close very fast. All right, the lender usually wants cash for the deal. all right? Because we want to close finance, and that's what hard money lending allows you. When we discuss further detail why we can close finance, approval criteria. We fund properties and people, right? The other lenders won't fund. We look at the and we will discover specifically what kind of properties we look for, what kind of properties are funded, and people, and kind of what we're looking for when it comes to working with other investors. And flexibility. We know that the best laid plans can go wrong, right? And also when we offer flexibility is the people itself, right? We offer more options. And in addition to that, I will also say that when it comes to flexibility, if you like a let's say experience, if you join with somebody who has experience and gain that experience, you have bad credit score, low credit score, join somebody who has better credit score. So we offer flexibility also in that aspect too, compared to traditional sources. How does the hard money financing work? How does hard money financing work? All right. Well, I do want to say that hard money specializes in underwriting and closing quickly. Usually, process for the application process is a couple of days, and the closing can be done within a week. All right. And again, it goes back to time of money and, and getting loans completed as soon as possible. All right. Where does money come from? This is a great question. Where does money come from? Money comes from private individuals. All right. Again, going back to what I was saying, the 2008 fund has great opportunities. I think right now we're starting to not a great amazing opportunity. What we do is we pretty much we allocate capital for these individuals. All right, and we do it in a method that allows us to do that on a larger scale. All right. So the money comes from private individuals who may like the resources to do it. All right, the responsibilities of the farmer lender include underwriting student loans. This is very important because this is what we do pretty much every day to start the loan process. We screen borrowers. Do they fit our criteria? We're looking for a certain credit score. We're looking for certain individuals. Does a borrower have bankruptcy? Does it have any liens, any tax delinquencies, any foreclosures? We want to know that because if the tenant does, if the investor has a bankruptcy, we might not be able to work with him. We want to evaluate the property. Is there immense potential to be made in this property? What's the condition of the property? If we sell it, is there a demand for this property? If we don't sell it, we finance the rental opportunity more. All right, and then we also collect revenue. So in this case, revenue will be in a sense of interest. And we'll cover this a little bit more in the next slide. Where is capital deployed? Capital deployed to purchase and develop property. It goes back to the essence that we're making a hard money loan. We're backing a hard asset in this case first. All right, so what's the scenario we still have this asset that we can either resell, and we still make some money. And I do want to emphasize that we're not here to acquire real estate properties. We're in the making loans. Like we want to make sure that investors succeed. Like we push our investors to make sure that we help them succeed because at the end we don't want them to fail. All right, draws. Another aspect of hard money lending is draws. Right, draws referring to when it comes to the receiving of renovation money for the completion of the project. We'll discuss more of this draws when it comes to the scope of work, which is used when you're applying for a hard money loan. Interest only payments. Interest always interest only. It's not like conventional methods where you have principal interest combination. It's an interest only loan and it's paid monthly. And please do keep in mind that you're not paying down the principal throughout the duration of the loan because it is a very short-term loan. It is a 12-month loan. So at the end of the day, at the end of the loan, either if it's 12 months, 6 months, you will be there will be a balloon payment, and that means that you'll have to be forced to pay back the whole loan. And how you do that is either by selling the property or refinancing the property. All right. I do want to give you a quick example how the traditional methods of financing kind of correlate a little bit with hard money. There's many distinctions, but I'll give you a simple example. Many homeowners, they require 20% down payment. For example, if you buy a $100,000 home, the buyer will need to bring in $20,000. All right. Or the lender will lend $80,000, and there's a loan to value of 0.8 or 80%. Now, how does it translate to hard money? All right. Well, when it translates to hard money, we don't only take into consideration the loan to value, we also take into consideration ARV, LTV. What was the ultimate value of the property? Because we understand that the property is distressed, but there's hidden value that other lenders don't see. But we're willing to take that risk.
to help expose the value, right? We take into consideration the purchase price, the rehab and ARV, the purchase of the property, right? In this case, we might give you 80 or 90% to purchase the property. So you might have to come out with 20, 15% down payment. Rehab amount will give you 100%. And ARV usually is done with appraisal company, or you could do it with a realtor, and you'll see what other properties are being sold for. We also take into consideration the location. We want to make sure there's an population. Also, that helps us also see demand. In terms of the power, if you have how much exposure you have, that's also things that we take into consideration as well. And now I do want to give you an example with numbers. Now this might not be so helpful at first, but with the next slide it will make much more sense. And I'll go with this for detail. You purchase a property for $50,000. I do want to emphasize that the first example of $100,000 was a property of turnkey, referring to a property that's already movable. All right, normal banks will not fund a property that needs major repairs because it's just too risky for them. All right. They want to make sure that the loan, the person taking the loan will be able to pay it off right away. Not pay it off right away. In this case, we're going to take the risk because there's potential to be there. So we have it is 20,000, ARV is 100,000, and again, ARV is at the fair value, and it's really what the property is needed for in the future. Loan to cost, it's 86%, so for ARV, LTV, 60%. Now, it costs more, is exactly what I mean by that. So you could kind of say the AR LTV is pretty much loan to value the property at the 100 mark or answer is what the property is actually willing to sell for. We also have loan to cost, which is 80%. Now, it's more of this further, but loan to cost is pretty much the purchase price of the property. In this case, was 80, so we do 80% plus the rehab amount, and we take that and divided by the full loan amount. In this case, we tend to do 90% loan to cost. Now, again, this might not sound, it might be a little hard to understand, but I will explain further in the next slide. In this case, this deal is a very profitable deal, and it returns 50% with profit of 11,000. Now, again, I know your heads are probably spin, so let me clarify a little bit more. Now, you see here in my mouth, the purchase price is 50,000. That's what you're purchasing the property for. All right, but we know the property is worth 100,000 based on compatible analysis for other properties in mint condition, condition, and so forth. Now we also have here the renovation, which is 20,000. Okay, and I want you to look at the leverage approval, which is 80. Pretty much is loan to value of the property. This is loan to value. How much are we going to need to purchase the property? Which in this case is 80. All right, 80 loan to value. We have more than 100%. We'll give you 100% renovation. And again, as you can see, how many limits taking the maximum risk is lending more than what the property somewhat worth now, but we understand that if you want to take generations, it's worth much more. All right. Now, I do want to emphasize here the ARV loan to value is 50, and we knew at least for capital, we do want to see a loan to value ARV between 60 and 65, because we also want that cushion. Worst case scenario, the property if it goes into default or something like that for closure, we could take it back, and we know that somebody could take possession of the property and realize it's down here, we could not be a loss. All right. And then going back to the loan to cost example, we want to be on energy. This deal is amazing. It's a really good deal. You can see you can make a profit of 1,000 with a return of 50%. I do want to kind of bring your attention to the acquisition cost here. We pretty much try to estimate all the costs associated with different transactions so that how much profit you're making. Some of the scenarios you're only paying certain fees, but we also have them so we can pay these fees. You might not have local fees, but we still want to them because we want to be on the safe side. It's very important for a loan officer to go with this to the clients to make sure that the client understands really what they're doing themselves to. And it also gives you an overview of kind of what we are looking for. Then we want to see loan to value ARV between 60 and 65. We go up to 70% individuals. We're very experienced. We can also go when it comes up to loan to cost, 90%. Very, very important for you to understand this in the hard money arena. All right. Loan to rates. I know most of you are probably waiting for this. I get so many clients for the first thing they tell me, "Dude, what are the rates and terms?" Usually I've never told their experience, but if you're new investors, I really like to first understand the goals and strategies because I really help them see where they're going to go. And as we'll see, we have, we're workable. The length of the term, like I said before, hard money loans are very short loans. So that could be short at 24 hours, a couple of days, months, or years, 1 or 2 years. As a lender, we want to be in and out quick. Okay.
Express capital, our loans always 4 months. Interest rates vary significantly and could be based on location, risk, or any other factors. Liquidity, net worth, or also something to consideration because the person has a lot of liquidity. This is one minimum because we know individuals can step in there and create the project or etc. Interest rates can be double digits. It could be around 8 to 12%. All right, and it might seem high because you can understand that they're going to take a lot of risk for this transaction as well. But again, it's a lot of opportunity, a lot of opportunity, opportunity. Origination points is just it's much also another administration fee and then based off the loan size. So 1 point equates to 1% of the loan down. In this case, it's 100,000. 1 point would be $1,000. All right, and so on and so forth. So make sure you know your points. Speak to your office about this. Fees. There's also other fees to process the loan, include underwriting fees, appraisal, water fees, and other administrative costs. This is pretty much to service underwrite the property, but also the continuation of making draws, which we'll cover later as well. Make sure you know upfront what rate points and fees to expect. This is very important. You have to understand what you're getting yourself into before you can decide because money cost. You want to know exactly how much money you're making. All right. So if you don't know your points, you might know exactly how much profit you're making. You could be at a loss without knowing your rates and terms. All right. So make sure you get a term sheet that outlines the terms and agreements of exactly the rates and terms you're going to be getting. Okay. What a home lender considers when funding a property. And this pretty much comes down to the 6 C's: collateral, condition, capacity, capital, character, and credit. When we look at the collateral, we want to see how the property makes money. We want to see how the property is, the condition of the property, the condition of the surrounding neighborhood, because we want to minimize risk. The condition of the property, how bad is it? Is it workable? Is there a demand for those type of properties? What we can sell them is there rental potential, rental opportunities. The capacity of an individual, can he execute the terms of the contract? We want to see some experience there as well. Capital, we want to make sure that the individual has some skin in the game, right? Because if he has some skin in the game, he's more likely to execute the contract because nobody wants to lose their own money. So you're willing to push further. Character, we do, and I'll discuss this in the slides, but we look at the person's credit score, background. We look at all those factors to see really, what the individual, how the individual is. All right. And then we look at credit. Credit is not the biggest factor because it's an asset-backed loan. So the asset separated from the individual. All right. And that's what's also very important, that the asset itself is what we really care. That's why we tend to close in LLCs. All right. Because the asset separate from the individuals. Can the asset without the individual produce it by itself? In this case, yes, it can. Okay. So we look at credit. A 500 credit score could be the difference between a yes and no. Okay, and we want to see how financially savvy the individual is as well. Then we get paid back as well. All right. Loan application. All right. The loan application pretty much just outlines information about the applicant. The names, the emails, the net worth, the liquidity, how much experience do you have, how many deals were done in the last 2 years. It's important because if the deals were done before 2 years, we might, the trend might be a little bit different, but we know if another individual has done 10 flips in the last 2 years, well, it's first. So we might get the better rates in terms, all right? And we also use personal identification such as a ID from the security number, all right? And this kind of helps us to identify an individual. Is John who John is, right? We want to make sure that John is John. So we don't want to make the loan too long individual. The purchase agreement. It outlines the terms of the contract, of the property, between the seller and the buyer. What are you buying the property for? How much you're buying it for? The contingencies. You have to know this. And we have to know as well. Right? Property insurance. Now you're holding the loan for a very short time, but anything can happen in the time where you're building the property. Or the construction of the property, the fix and flipping. Somebody can get hurt. We want to make sure that somebody that there's insurance. All right? Because the last thing we want is to get sued and something happening with the project, right? So we want to make sure we always play safe. We want to have insurance. All right, renovation budget. And we also call this scope of work. We want to know how much it's going to cost for you to renovate it. Does the number make sense? We have to know all this, okay? And usually it's done in phases. We do send a appraisal
not appraisal, excuse me, an inspector to go check every face to make sure that we can make you the next draw. Because if you're not, and it also helps us to help you. All right. So those are some tips, some ideas, some general ideas of really how Harmony works, what to expect when talking to a Harmony lender. Now I'll leave it open to Q&As. I do want to say that we're raffling this book, Never Split the Difference, by Chris Voss. I read this book; it's an amazing book. We're gonna be raffling it out. Please put your emails down, and I'll raffle it out. And we're also giving free appraisals for the month of August. If that's something you're interested, please also drop your emails. I want to say thank you to everybody who joined my webinar today. I really appreciate it. I know it's a Sunday. But again, thank you so much, and I wish all of you the best. So if anybody has any questions they might have for me. And I'm sorry that the sound wasn't the best and clear. I'll try to do better next time, maybe bringing some headphones on.